Hello everyone, welcome back to another video on the channel. This is the 5th video in my How I Trade ICT concept series. I apologize for the over year-long wait on this video. Right after I made the last one, I was getting ready to move from the US to the UK. Finally got to a level of normalcy. I figured I'd start working on these videos again, especially since we're less than a month away from starting 2026. So I kind of want to try and push out these videos for all of my family and friends that keep asking me to show them how I trade or how to trade. With that being said, let's jump into it. The last video, we talked about the interbank price delivery algorithm, or IPDA. We talked about consolidations, expansions, retracements, and reversals, what they look like. And then we also talked about the order in which they can or cannot happen based on the current phase of price. In today's video, we're going to talk about premium discount arrays, or PD arrays. And these are patterns in price that you can see on any chart, any time frame chart, any instrument. Anything that's tradable that has a candlestick chart, you can see these PD arrays in it. It works on crypto, it works on Forex, works on the indices, works on equities, works on commodities. It works on everything, which I think is what makes ICT's concepts great. We're going to talk about fair value gaps, both a BISI and a SIBI. We're going to talk about inversion fair value gaps. We're going to talk about order blocks, breaker blocks, volume imbalances, and liquidity voids. We're going to talk about consequent encroachment and mean threshold, and then we're going to look at the PD array matrix. The PD arrays that I have here listed are not all of them. These are just the ones that I focus on. They're the ones that I love to trade the most. ICT teaches a lot of strategies, a lot of techniques, a lot of things, but as you study his concepts and you dig more deep into it and you back test and forward test and you're executing your trades, you'll come to find out what stuff you like to focus on. And he actually recommends that you do that. He always advocates for just picking one and being really, really good at it. I kind of did the same with his PD arrays. I only focus on a few. Some people focus on all of them. Some just focus on one. It really doesn't matter. It's just what works for you. So I'm going to go over the ones that work for me. So let's get into the charts. I'm only going to go over what they look like. I'm not really going to dive too deep into the advanced stuff because then we're going to be here all day. A fair value gap is a 3-candle pattern that has the first candle, and then it has a second candle that basically makes a large pass through. And then there's a third candle that basically closes after the second candle. And then the combination of the first and the third candle make a gap. This here is a fair value gap in the form of a BISI. And this is a 15-minute chart. Going back to what I just said, this is the first candle. This is the second candle. This is the third candle. So the first candle closes, second candle opens up, third candle opens up, comes down just a little bit, and then goes higher, closes higher. This is the gap that it makes. This is a fair value gap right here. This is a fair value gap as well. So is this, and so is this, right? These are all fair value gaps in the form of a BISI. BISI stands for buy side imbalance, sell side inefficiency. The reason why it's called a BISI is because only buy side was offered in this move higher. Same with this one and this one. At no point was sell side or downside delivered between this gap. Went higher, went higher, went higher. The only buy side was offered on the upside between these candles here. It's inefficient in that sell side was not offered before it continued going higher. The same thing can be said for a fair value gap to the downside. This is a 15-minute fair value gap in the form of a SIBI. And then this is one here as well. There you go. First candle, second candle displaces down. Third candle closes, forms the gap. Same thing here. Candle 1, candle 2, candle 3. That's the gap there. And it's a sell side imbalance, buy side inefficiency in that there was no buy side offered at all. It was just sell side. Okay? SIBI, BISI. That's all you need to know. You'll know who the brand new ICT traders are because when you look at their chart, they just have rectangles all over the place. They mark out every single fair value gap, as opposed to more seasoned ICT traders where they only focus on a select few. The normal operation of a fair value gap is rejection and a continuation. If we're talking about a BISI, you take that 3 candle formation, you outline the gap, you extend it out in time, and then when price retraces into it, that's your entry. And then your stop is below the fair value gap. And then you trade it in the same direction that the gap was made. When we're talking about SIBIs, you want to see the opposite. Candle 1, candle 2, candle 3, that makes a fair value gap here. So you want to see price come back into it and then go lower. So your entry would be here, stop would be above the high, and then you would trade it to the downside. You would have got stopped out here on this instance here, but there's more to it than just trading fair value gaps. You have to have narrative and an idea of the higher time frame, but we'll get into that in later videos. This is a breakaway gap. A breakaway gap is when there's a fair value gap that price doesn't revisit before going lower. So in this case, there's a fair value gap here on the 15-minute chart, and then there's a 15-minute fair value gap up here as well. It didn't go into this one. So this is a breakaway gap or a breakaway fair value gap. And I didn't put that on the list because it's simple to explain in this manner. It's like a fair value gap that just doesn't get retraded into. Technically, this is a breakaway gap here as well. Same thing with this, because these are both fair value gaps by definition and by formation. 2 were made here. Technically, 3 were made. There's a little tiny one there. Yep, so 3 were made technically. We only retraded into this one, and then we left these 2. So both of these are breakaway gaps. And then when price rallied, higher, 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 so much higher, before it finally retraded into the lower ones. But it did, touched it briefly, and then went a lot higher. Next is an inversion fair value gap. So we have a BISI here, candle 1, candle 2 displaces higher, candle 3 low is right there. So that is our buy side imbalance, sell side inefficiency. Because again, buy side was offered, but no sell side until this candle broke through it and then came back. So in this case, if you were watching this, you would want price to come into it and then go higher. However, price went up, made the fair value gap. It broke way below the low. And then we came up and then we went lower. This 15-minute BISI is now an inversion fair value gap. Inversion meaning it switched from a bullish stance or a bullish catalyst to a bearish catalyst. So over here, since we didn't hold it bullish or use it as support to go higher, and then we went lower instead, now when price comes back into it, you're going to expect that it's going to hold price down, which in fact it did. Now the same thing can be said about this one. We're looking at this fair value gap here, which is in the form of a SIBI, right? Sell side imbalance, buy side inefficiency. Normal operation, we would want to see this fair value gap be formed, price come into it, and then we go lower, right? That's the normal operation. Stop above the high, right? So if we were shooting for this low right here, well, I guess you could go off of both because that's sell side there. And then this is sell side here as well. Price comes down, comes higher. This is your sell side liquidity. Trade short here, target the downside. So if you shorted this, put your stop above there, and then we're targeting this short-term low, bam, we hit it. Did it again here, price went higher, took out this short-term buy side. If you shorted the midpoint of that, stop above here, shot for the short-term low, which is now this, bam, hit it here. This is acting as a normal sell side imbalance, buy side inefficiency. However, if you were to pull this forward, you can see how price starts to invert it. 1, 2, 3 touches into this sell side imbalance, buy side inefficiency. However, it uses the low of it right here. Look at how precise that is. That's to the tick. Precision. And then we went higher off of that, and then price closed above it. This is bullish, pulls back onto it, and then goes higher. So it's a SIBI right here. And then when price gets to this point, now it's inverting that fair value gap. Once I see price close above a SIBI, I'm no longer looking for that to act as bearish. Same thing with a bullish fair value gap. If I see a bullish fair value gap and price closes below it, I know that I'm more than likely going to get stopped out, or I know that I'm not going to enter that trade because it's more than likely going to come a lot lower. But that is what an inversion fair value gap is. All right, so next on the list is an order block and a breaker block. I do have to preface it by talking about what a change in state of delivery is. A bullish change in state of delivery is where you have a candle closure above a red candle that essentially reverses the move. So if we're looking at these red candles here, low to high, as soon as we get a green candle close above the body of the highest red candle, that is a change in the state of delivery. And this is a 15-minute chart. So this is a 15-minute change in the state of delivery. So we have a green candle going up, 3 red candles going down, and then we have 2 green candles going up with the second candle closing higher than this candle's body. So that is our change in state of delivery. Now, a bearish change in the state of delivery is when you get a candle closure that's bearish below a green candle's move. So in this case, we have 2 red candles going down, we have a green candle going up, and then we have 3 candles going down with the second candle closing below the low of this candle's body. So this is another 15-minute change in state of delivery. However, this is a bearish version. That is all you need to know as far as a change in state of delivery. Now, a bullish order block is the red candle or the series of red candles right before we had a change in state of delivery. And it's the entire range from the top of the wick to the lowest point, which in this case would be here, lowest point here, highest point here. So this is our order block. So this is a 15-minute bullish order block. And then likewise, this is a 15-minute bearish order block. See how this order block here is just 3 consecutive red candles? This whole thing is our order block. However, this one, this green candle, there's only 1. So we're only highlighting this 1 candle. If there was, 2, 3, 4, 5, however many candles there are, then that is the whole range would be the order block. Now, the difference between an order block and a breaker block is in how they form. A bullish order block, a low, low, high, lower low that takes out the previous swing low, and then a higher high that also takes out the previous swing high. And then a bearish breaker block is going to have a high, a low, a higher high that takes out the previous swing high, and then we're going to have a lower low that takes out the previous swing low. So with these drawings made, all I would have to do is just drag it over price. So if we're focusing on this price action, low, high, lower low, higher high, then our change in state of delivery would be right here. Pull that out. And then this right here would be our breaker block. It would be the green, not the red. There you go. So there's our 15-minute bullish breaker block, because it's the last green candle or the highest green candle right before we did that sweep down that made the lower low. Low, high, lower low, higher high. Same thing can be said about the bearish breaker block. So we have a high, a low, a higher high, and then a lower low. So our change state of delivery is still this green right here. And then our breaker block would be this right here. There you go. And that's just highlighting these 2 red candles because it's the lowest red candles right before we went up and made the higher high. And if we were to take that drawing from here, then it would be like that. Right? So high, low, higher high, that takes out that previous swing high, and then a lower low that takes out the previous swing low here and does the change in state of delivery. As you can see, we get reaction of price off of these breaker blocks according to how you're supposed to trade them. They work similar to fair value gaps in that when price breaks above it and comes back down, that's where you want to be going long on a bullish breaker block. And then if price comes down, does that change state of delivery, price comes back up, then you want to be shorting that and shooting for lower targets to the downside. That is the difference between an order block and a breaker block. They both need a change in state of delivery, but different in how they are set up. But that's all you need to know for order blocks and breaker blocks. Next, we're going to talk about a volume imbalance and a liquidity void. This right here is a volume imbalance. It's a signature in price where there is no overlapping candlesticks in that area. So see how this candlestick's body low stops here, and then this candlestick's body's high is right there. This in between is a volume imbalance. Only the wicks are overlapping. There's no candlesticks. See how this candlestick overlaps that candlestick overlaps that. These are overlapping each other. There's no volume imbalance here, or there's no point in where the candlestick is not overlapping and it's just the wicks like this is right here. That is a volume imbalance. So this is a 30-second chart. This right here is a liquidity void. So see how there's no wicks or candlestick bodies here? This is a liquidity void, meaning that there was absolutely no price action in this area. No wicks, no bodies. There's just nothing there. That is the difference between a liquidity void and a volume imbalance. You can see them a lot on the lower time frames, but you see them very, very rarely on the higher time frames. I don't usually use volume imbalances and liquidity voids all that much when I'm trading on the on the lower time frames. I mainly pay attention to them on the higher time frames, like the daily, the 1 hour, the 4 hour, and the weekly and the monthly. Those are really the only times I pay attention to them. Second to the last on the list is consequent encroachment and mean threshold. Now, when I'm drawing these things, you'll notice that there's a middle line, a middle dashed line on the drawing. That is consequent encroachment if we're talking about gaps. And it doesn't matter what kind of gap it is. Fair value gap, new day opening gap, liquidity voids, volume imbalances. The midpoint of gaps are called consequent encroachment. If you're looking at order blocks and breaker blocks, like anything that's not a gap, the midpoint is called mean threshold. Okay, so the last thing is the PD array matrix. If you look at this, this is talking about the range in which you're looking to trade, right? So we have premium, or the top 50% of the range, and then we have discount, which is the bottom 50% of the range. Equilibrium is what we call the halfway point of the range that we are looking to trade in. This is how you would look at the PD arrays when you're looking to take a trade. So let's say I'm looking for a bullish move after price retraces down into discount, right? Or the bottom half of the range below equilibrium. The first thing that I would personally look for is a bullish breaker. If there's no bullish breaker, then I would look for a liquidity void or a volume imbalance. If there's no liquidity void or volume imbalance, then I would look for a fair value gap to trade. If there's no fair value gap, then I would look for an order block. And if there's no order block, well, I don't use rejection blocks, but if there's no bullish order block, then I probably just won't even trade it. I would just wait because it's probably going to run the lower, the old low. I don't know why it says high here if it's on the bottom. Same thing with up here. I don't know why it says old high or old low if this is the high. And then same thing to the upside. If you're trying to frame a short trade and you're waiting for price to come up to short it and then go lower, the first thing you would look for, or the first thing I would look for, is a bearish breaker. Then if there's nothing there, I would look for a liquidity void. Actually, I won't even look at that because I don't use it on the lower time frames when I'm entering. So I would then look for a fair value gap. If there's no fair value gap, then I would look for a bearish order block. And then if there's no bearish order block that I can see, I'm probably just not going to touch it at all, right? I'm just going to let it give me more information. In the beginning, I talked about only using what I feel works for me, right? Or the ones that I like to trade. If you look at the ones that I didn't go over in this video, which was the mitigation block and the rejection block, let's just talk as if I'm waiting to get into a long trade because I think price is going to be bullish. If I'm waiting to get into a long entry, I want to get in where I think it's safe. So if I'm looking for a trade to go long in, I wouldn't want to get in on the first PD array. I would want to get in on the ones that are a little bit lower, right? Because if you try to get in on a mitigation block, if that doesn't hold, then it's going to go to the next one. If that bullish breaker doesn't hold, then it's going to go down to a liquidity void, right? If that doesn't hold, it's going to go down to a fair value gap. If a fair value gap doesn't hold, then a bullish order block is the next stop. If that doesn't hold, then you better hope the rejection block holds it. Otherwise, you're just going to get stopped out. Because whenever you are looking for a bullish trade, you get in on whatever entry model you want to get in on, and your stop usually goes at the low, the swing low. Likewise, if you're shorting and you get in on any of these, your stop goes at the high. With that being said, I don't want to get in on a mitigation block, right? I would much rather get in on something like a breaker or a fair value gap or a bullish order block. Likewise, I don't want to get in on a rejection block because that's the last stop before my stop gets hit. So yeah, I could get in on a rejection block for the best risk to reward because that's the very low before it gets stopped. If price does come down to a rejection block and then it runs higher, this is your best place to get in on. But if price doesn't hold any of these, the likelihood that this is going to hold it is very, very minimal. ICT says that the bullish breaker is the strongest, or it takes precedence over all the other ones. So if a bullish breaker isn't going to hold, then you better hope that these do. Otherwise, you're just going to get stopped out. That is why I don't really focus on those. When I'm trading, I've found that the breaker, the fair value gap on the order block is really all I need. Whenever you get PD arrays that stack up on top of each other, those are always the best trades. For example, this, right? This is a bullish order block, or well, it's a breaker block. So low, high, lower, low, higher, high. So this is your breaker block. Extend that out. What else do you have here? You also have a fair value gap here. You have a fair value gap here. Now that we have a change state delivery there, and then we also have a fair value gap, we have a breaker block or an order block, however you want to frame it, because you have multiple things that are giving you the narrative that price is going to more than likely go higher, right? So takes out swing low here, liquidity, displaces higher, pulls back into it. We use the breaker block, the fair value gaps, the change state delivery, and then we run higher, right? Bam. Those are always the best trades because they offer more than just one thing, more than one confluence to help you form your narrative as to why you think price is going to go where it is. That is it. Those are the PD arrays that I look for and I pay attention to when I'm trading. It'll get a lot more interesting from this video on. So hopefully you're still watching. Hopefully you're inclined to continue watching, and I'll see you all in the next video. Bye everyone.